99% of retail traders are losing sleep trying to predict the exact moment a so-called crypto whale is going to make a move. They scour Twitter, track wallets, and they still get completely crushed. Today in this explainer, we're tearing down the mythology of the crypto whale and showing you how the market actually moves.
Honestly, we've all been there, right? You're staring at a chart, minding your own business, and suddenly a coin you're watching just violently pumps out of nowhere, or worse, it just absolutely dumps into the abyss. And you're sitting there thinking, who on earth is doing this to me?
It genuinely feels like there's some shadowy group in a boardroom just plotting to liquidate your specific position. So is the market just completely rigged against the little guy? It's definitely the most common question out there, but it's totally based on an illusion. The truth is, there are no magical manipulators pulling puppet strings behind a curtain. What we're actually looking at here is just basic market physics. Big money doesn't operate on magic, it operates on pressure. And once you understand how that pressure works, the whole system suddenly becomes crystal clear.
Let's jump into Chapter 1, Meet the Crypto Whales. So let's set the stage for what big money actually means in this space. A crypto whale isn't some special exotic species of trader. It's simply an entity, could be a person, a hedge fund, an algorithm that controls enough capital to actually matter. But here is the absolute crucial point. Size is entirely relative. If you have a wallet with, say, $1 million in it, you are an absolute behemoth in a tiny unknown microcap coin. You can single-handedly dictate the price. But take that exact same $1 million over to Bitcoin, you're just a tiny fish. You wouldn't even cause a ripple. So being a whale isn't about just being rich. It's about being large relative to the specific market you're trading in. I absolutely love the rooftop water tank analogy from our source material for this. Think of a market like a giant water tank sitting on top of an apartment building. If you or I throw a single bucket of water in there, the water level doesn't visibly change. Nobody taking a shower downstairs notices a single thing. But a whale isn't a bucket. A whale is a giant industrial valve, opening up all at once. Suddenly, the flow changes for literally everyone connected to that system. All right, Chapter 2, How Big Money Moves. So what are the actual mechanics of their trades pushing the price up or down? Most people think of price as a fixed label slapped onto an asset, like a price tag on a shirt at the mall. But price is actually just a temporary, super fragile truce between buyers and sellers. It's a tiny negotiation saying, hey, I'll buy here and you sell there. Price only stays stable when both sides are balanced. But when a whale enters and one side completely overwhelms the available supply, that truce breaks. The price literally has to move to find a new agreement. It's not magic, it's just forced relocation. Right. And this brilliantly illustrates why liquidity is everything. Liquidity is essentially the depth of the market. If you take a heavy stone and throw it into a wide, deep river, it barely makes a splash. The river just swallows it whole. That's a highly liquid market, like Bitcoin. But take that exact same heavy stone and drop it into a tiny, shallow backyard pond. It makes a massive, violent splash, displacing the water everywhere. That's a thin, illiquid market. Whales impact those thin markets the absolute most, simply because there isn't enough water to absorb their stone. Exactly. So how does that splash actually happen on the charts? It happens because markets move by eating the order book. Imagine a hallway completely packed with people. If you want to get to the other side, you can't just teleport, you have to physically push through the crowd. In the market, the order book is like shelves of supply. A whale buying aggressively doesn't just magically get to buy all their coins at the lowest price. They buy everything on the bottom shelf, empty it out, and then they are forced to reach up and buy the next shelf, and the next and the next. They push the price up by literally consuming the supply. Which brings us to a really fascinating point. Did you know that whales rarely place one massive, obvious order? They know everyone is watching them, so instead of dumping the whole water tank at once, they split their massive orders into smaller pieces. It's kind of like filling a bathtub one bucket at a time. One splash doesn't alarm you, but if the buckets keep coming relentlessly, suddenly the water level has risen drastically and you didn't even see the giant coming. Moving on to Chapter 3, Reading the Whale's Footprints. So if they are deliberately hiding their movements, how do we spot them? The source material describes a whale trade perfectly. It says, a whale trade is a sentence heard through a wall. Think about that for a second. You hear a loud shout from the next room. You know something big just happened, but was that shout an angry scream? Was it an excited cheer? Was it someone just telling a joke? You hear the noise of the trade, but the intent? That is highly ambiguous. Now, think about how we actually break down that ambiguity.
Say you see a massive sell-off on the blockchain, and every single crypto alert account starts screaming, bearish. But hold on. What if that massive sell isn't a whale panic dumping? What if it's just a forced liquidation? Or, a fund that's legally required to rebalance their portfolio? A huge sell doesn't automatically mean the big money thinks the coin is going to zero. You hit the nail on the head. Context decides the meaning. Two identical $10 million whale buys can produce vastly different outcomes depending entirely on where the price is and the available liquidity. If a whale buys heavily at a major support zone, the market might completely rally behind them. But if they buy heavily into a thin, quiet market, it might just be a temporary spike that immediately crashes back down the second they stop buying. The action is exactly the same. The environment changes the result entirely. Which leads perfectly into Chapter 4, the big whale trap. Right. This is where we need to dismantle the biggest, most expensive mistake retail traders make when they follow crypto alerts and hype online. Because whales don't leave clean little labels that say, hey guys, I am buying now. They leave subtle clues. We're looking for footprints. Things like abnormal volume out of nowhere, a sudden evaporation of liquidity, repeated buying slowly over time, or a price that stubbornly holds its ground despite massive selling pressure. We are looking for clues, not absolute black and white verdicts. And the trap is confusing what you see with why it's happening. Visible action does not equal hidden motive. When retail traders see a single massive wallet transfer, they immediately guess the whale's intent. Oh, smart money is loading up. I need to buy right now. They mistake a tiny fragment of data for the whole story. Actually, scratch that. That massive move might just be internal bookkeeping between exchanges. If you react to an ambiguous signal as if it's a direct command, you will get trapped, for sure. Finally, Chapter 5, your new trading edge. So how do we fix this? How do we build a future-proof mental shift so you never get manipulated by whale hype ever again? Well, it boils down to a 3-layer system. Step 1 is the action. You observe that something changed, like a big buy or sell. Step 2 is context. You ask where the price is and what the liquidity is like. Basically, why does this action matter right now? And step 3, which is the most important one, is reaction. Did the market actually accept the whale's push, or did it immediately reject it and fall back down? Listen, if you take away just one thing from this explainer today, let it be this. Stop guessing intent and start reading the effect. Stop asking, what is the whale's thinking? You will literally never know. Start asking, what is the whale's action doing to the short-term balance of the market? The intent is a hidden secret. The effect on supply and demand, that is visible right there on the chart. A whale is not a prediction. A whale is a force. Once you make that mental shift, you stop being a victim of the headlines. You stop reacting emotionally to every big green or red candle. You start viewing these massive trades as just market forces, kind of like the weather. You weigh the evidence analytically. So the next time a massive trade hits the tape and all the chat rooms are screaming in panic or FOMO, you don't have to join the chaos. Just sit back, look at the order book, and ask the only question that actually matters. What is the market actually doing with that information?
Absolutely. Look, if this shattered your illusions about how the market really works, hit that like button. Share this with a trader who desperately needs to hear it, and make sure you subscribe and come back for more. We've got plenty of market myths left to break. See you next time.